Hey guys, welcome to this video. Will Sebastian here from TradingView. If you've seen me on there, if you haven't, great to meet you on my YouTube. In this video, I'm just going to debunk all the myths that you see online. I've got a whiteboard so I can just write them on and everyone can see them really easily, a little bit like a class. There's so much BS online for people who are trading. They make awful decisions and they lose a lot of money. So we're going to brush that up and change all that today. So number one, what's the first thing that people come into the trading world and do? Well, it's really simple. They buy highs, okay? They buy highs and also they sell lows. Now, if you are someone who either runs a business or wants to run a business and you buy goods, would you buy your goods for an expensive amount knowing it's going to throw your business under the floor? I really don't think so. Conversely, if you were selling goods as a business, would you sell them extremely cheaply and also risk going underneath? You wouldn't do it. So why, when you open up your broker account, do you see a massive move up in the price, get FOMO and load in? Conversely, when the price is falling right down and you sell, why? You're selling cheap. Now this is the number one rule to make any business of any type go wrong, whether it's trading or not. So you need to make sure that you're buying low and selling high, because that in essence is the only way you can actually make money. And if you're not doing that, then things are going to go wrong because you'll buy high right up top, get a little bit of FOMO, and you'll find out that it hurts a lot, and you'll get the same with when the price goes low. And often you'll see traders who are in the market actively looking to get good positions. They just won't do that. And that is why you need to use all your time frames collectively. So the next part is number two. Number two is indicators. Okay. Now you'll notice if you follow me, I talk very heavily about indicators. The reason why I do that is simple. It's because people use what's called, or what I call, a line-up strategy. Now I say that because if you're looking simply for your indicators to line up so that you can buy or sell, you're going to find that often that is going to be a massive problem and you're going to lose money. Now you'll probably see it on something like an RSI, the relative strength index, or some kind of, Fibonacci levels. You're just sitting there and waiting until they get hit, and then that's your entry confirmation. Now you shouldn't do that because you won't find that the price bounces away where you want every single time. And if it did, everyone would make money trading. So indicators, the real purpose of them is to actually use them to gauge the market value, or in other words, gauge how good the price is at any time. Whether the price is low, as we discussed, or whether the price is high. And you need to be able to do that in that way, because if you're using indicators as magic line here, in other words, your Fibonacci level gets hit, or something like that, then it's not going to work very well, okay? And that is just because indicators are not for that. Indicators are to measure how good the price is based on whether it's low or high, and therefore what you should determine your risk management as, which leads me on to number three, okay? And number three is quite simple, and we'll stick it right on the bottom here, and it's risk management. So why is risk management necessary? Well, lots of newbie traders, when they come into the markets, they completely avoid risk management and they don't understand it. In other words, if you're looking for a low price, let's say the indicators have told you that, then you need to basically put your position size in line with how low the price is or how high the price is. So if you've just had an uptrend and the price pulls back slightly, you might be using a fib level, and it hasn't gone very far, let's call it 23.6%, you're not looking for the 23.6% line to get hit, you're looking to get long to the proportion of how far the market has pulled back, because the price is going to be either low or too high. Now, if you've only pulled back 23%, it's likely the price is still quite high, so it doesn't make sense to have the same size trade as you would on a much lower price, because the probability is different, okay? The probability of the price continuing upwards changes, and that's because the market hasn't pulled back and you're not getting a profitable price. So risk management is really key, and that really correlates to having an appropriate risk size for every single trading situation. Okay, and every single trading situation will be based on market value, which is buying low and selling high, which you can tell from indicators, and of course other market methods, and understanding the natural process of markets as you spend longer inside of them. So to summarize, the 3 points are that you should buy low and sell high, not buy high and sell low, which is the opposite. Your indicators you shouldn't use as a magic line strategy. You want to use them to gauge how low or high price is. And then risk management tying in at the end really is going to determine how high, sort of how big your lot size is per these points. And in with that is other things like market sentiment and price action. Now they're more developed and we'll talk about those in another video, but getting started, stick to these 3, understand them well, and they'll greatly benefit your trading, keep you safe in the market, keep you in control of your drawdown, and keep you in control of yourself. So get steady and consistent gains, trade really small. If you haven't started sort of getting out there yet, start the paper account until you've got things mastered. Take your time. Thanks for watching, guys. Hope that helps. If you want to get on board with myself, go in the comments of this video. I'll see you there.